thoughts about what we see going on today, and thought we'd start by taking a little introspective and thinking about what things have been going on. So since the Great Recession started, it seems like all we've had is nothing but worries and worries and worries. And so I thought and what came to mind when I was thinking about this presentation today was the old stock market saying that markets climb a wall of worry. And then I always throw in my favorite quote. You've all, I'm sure, seen this before. The four most dangerous words in investing are, "This time it's different." So I take a look back at some of our quarterly client webinars that we've done in the past and over the past few years, and see what some of the things that we were thinking about then and how they compare to where we are now. So the first stop I made, what I want to make, is in the summer of 2010, when we were talking about stock market corrections. That is when the stock market has a pullback. And the definition of a stock market is when the stock market falls 10% from a high point. And so this table looks at corrections since 1962. In the bull market, how far the market moved during that period and how long that lasted. And then how many of these 10% quote corrections unquote occurred during that market, how far they were, and how long they lasted. So generally there's about one, but we could see that not always. We have this one in 1974 where there were 6 corrections, which moved our average up quite a bit. But the change on the corrections averaged minus 12.3 from the time that drop in the market, and that you could see is a pretty consistent number as you look up and down the column. But if you look at the length of when the market correction happened, it is all over the map, as short as 20 days and as long as 288 days. So when it says there's an average 126 days, that doesn't seem to mean much to me, because the length of time is all over the map. For those of you that are into statistics, into statistics, can't talk. It's not a bell curve when you look at this. Not a very good bell curve when you look at the column of the numbers. Okay, they're all over the map, but they do occur with some degree of regularity, and the amount that the market goes down and then it comes back is pretty consistent. Then we looked at the summer and spring of 2011 and looked at what we were worried about. And when I looked at the presentation, we were talking about the federal budget and the debt ceiling, things that Congress were talking about in there, the unrest in the Middle East with the Arab Spring. We were worried about, with all the government spending, was inflation going to come back? When was unemployment going to get better? And the real estate market still sucked, and gas prices were high. And then that fall, the Eurozone topped our list of worries, as did the political gridlock, which seems to have been the theme for the last several years. In our October call of 2011, we kind of took a look at the big picture from an historical perspective, looking all the way back into the 1700s. For financial crises, and took a look at the one that we had just had and said, what if it was average? And so the average price decline in housing would have been 35.5% drop in prices. I think depending on where you lived, it was a good deal more than that, or something less. It would typically last about 6 years, which would have housing turn around in 2013 or 2014. Interesting. The average unemployment rate would be 7% for 5 years. Well, we haven't got that. We've been higher than 7%. The average debt increase is 186%, and the typical crisis would last 4.4 years, or till 2012 or 2013. Throughout 2012, we were worried about politics and the election, as well as the national debt, and it just seemed like every few weeks or a couple months, the Euro financial thing would pop up. And we're still worried about housing, and we're still worried about unemployment and all these other economic factors. So meanwhile, how are your investments doing? Markets really didn't care about our worries. This goes to that saying that I opened with, the market climbs a wall of worry. We had all this horrible stuff we were worried about for years and years and years. Meanwhile, the U.S. stock market went up 100%. It doubled. And international stocks went up 150%. So let's look. This graph shows U.S. GDP per capita from 1871 through 2009. You can kind of see the little dip at the end, which is in 2009 we were still in the Great Recession. But gosh, you can see the Spanish-American War, World War I, the Roaring '20s, the Great Depression, World War II, the Korean War, the Vietnam War, the Black Monday stock crash in 1987 when stocks had the single biggest one-day percentage drop ever. They dropped 22% in one day. We see the internet stock bubble where we are now. So I think the point of this is through all this stuff, 140 years roughly, the trend has been fairly consistent. And the projections now for the future is that we're going to continue to look at a 2 to 4% growth rate. And we're a pretty big economy, so 2 to 4% really isn't bad, although we need the higher end of that in order to continue going.